Right now, as you are watching this, gold is trading at approximately $5,000 per troy ounce. Let that sink in for a moment. Just 5 years ago, you could buy that same ounce for under $2,000. In 2025 alone, gold delivered a stunning 63% return, its strongest annual performance since 1979. Meanwhile, the US dollar index, which measures the greenback's strength against a basket of global currencies, has tumbled to a 4-year low, breaking below the 97 level, a threshold that was considered psychologically unthinkable just 18 months ago. Something profound is happening in the global financial system, and the people who understand it are positioning themselves accordingly. The people who ignore it could watch their savings slowly erode while they're not paying attention. This is not a story about speculation. This is not a story about chasing returns. This is a story about one of the most fundamental tensions in modern economic history. A tension between the world's most powerful reserve currency and the world's oldest store of value. And right now, in February 2026, that tension is reaching a breaking point. The decisions you make in the next 12 to 24 months could genuinely determine the financial trajectory of the decade ahead. So let's dig into the real data, examine what the institutions are actually doing, and build a practical, disciplined approach to navigating this moment. To understand where we are, we need to understand where we came from. On August 15, 1971, President Richard Nixon made a televised announcement that permanently altered the architecture of global finance. He suspended the convertibility of the US dollar into gold, effectively ending the Bretton Woods system that had governed international monetary relations since the end of World War II. Before that moment, 1 ounce of gold was fixed at $35. The world's currencies were pegged to the dollar, and the dollar was pegged to gold. It was an imperfect system, but it had an anchor. After August 1971, the anchor was cut. The dollar became what economists call a fiat currency, backed by nothing more than the full faith and credit of the United States government. In the 55 years that have followed, the U.S. national debt has grown from under $500 billion to more than $38 trillion as of early 2026. The federal deficit in fiscal year 2025 alone reached $1.78 trillion. The Congressional Budget Office projects that net interest payments on the national debt will rise from 3.2% of GDP in 2025 to over 6% by 2054. Let those numbers stay with you, because they explain, more than any other single variable, why central banks around the world have been quietly but aggressively moving away from U.S. Treasuries and into gold. This is not conspiracy theory. This is verifiable, documented behavior by sovereign institutions. According to the World Gold Council, central banks globally have been purchasing gold at historically elevated rates for the past 4 consecutive years. In the first quarter of 2025 alone, central banks bought 244 tons of gold, the strongest first quarter on record. China has added over 350 tons in recent years. Poland, which had 4 times fewer reserves just a few years ago, has dramatically expanded its gold holdings. Russia now holds over 2,300 tons, and the significance goes beyond raw numbers. In 2025, for the first time, the share of gold in global central bank reserves surpassed the share held in U.S. Treasuries. Gold is now the world's single largest foreign reserve asset. This is a historic milestone that received almost no mainstream media coverage, but its implications are enormous. The concept driving this shift is something analysts call de-dollarization. It is not, despite what some commentators suggest, the imminent death of the dollar. The dollar remains the dominant currency for international trade, oil pricing, and global settlements. But its share of global reserve holdings has been declining for 2 decades. In 2001, the dollar constituted roughly 71% of global reserves. By 2025, that figure had declined to under 58%. That may sound like a gradual and manageable decline, and in normal times it would be. But when you combine that trend with a $38 trillion national debt, persistent annual deficits running between 6 and 8% of GDP, and a Federal Reserve that has already embarked on an easing cycle, you start to understand why institutional money is flowing toward an asset that cannot be printed, cannot be sanctioned, and cannot be defaulted on. Gold's relationship with the dollar is fundamentally inverse and has been documented across decades. When the dollar weakens, gold typically strengthens because gold is priced in dollars globally. A cheaper dollar makes gold less expensive for buyers using other currencies, which stimulates demand and pushes prices higher. But the current dynamic is more complex and more structural than a simple currency trade. The dollar index began 2025 near 109, spent much of the first quarter above 106, and then entered a sustained downtrend. By early 2026, it had fallen to approximately 97, a 4-year low. Bear positioning in the dollar has reached its highest level in 14 years, according to recent market data. And critically, the weakness is not merely technical. It reflects fundamental concerns about fiscal sustainability, erosion of confidence in U.S. policy, and the early stages of what some economists are calling a structural repricing of dollar assets. The Federal Reserve, for its part, made 3 consecutive interest rate cuts in 2025, bringing the federal funds rate to a range of 3.5 to 3.75%. Goldman Sachs has forecast 2 additional cuts in 2026, which would lower the floor toward 3%. This matters enormously for gold because gold is a non-yielding asset. When interest rates are high, holding cash or bonds generates a meaningful return, which makes gold less attractive in comparison. When rates fall, that opportunity cost shrinks, and the relative appeal of gold increases significantly. In the current environment where real interest rates, that is nominal rates minus inflation, remain under pressure, the structural case for gold has rarely been stronger. The numbers from the past 25 years make this case clearly. From the year 2000 through 2025, gold delivered cumulative returns of approximately 1,075%. That translates to an average annual return of roughly 10.9%. Gold has outpaced the S&P 500 on a price-only basis over this period, though the S&P 500 narrows the gap considerably when dividends are reinvested. In 2025 alone, gold gained approximately 60% compared to the S&P 500's 16% rise. This does not mean you should abandon equities. The data is clear that a diversified portfolio including both stocks and gold has historically provided superior risk-adjusted returns compared to either asset class alone, but it does mean that if you have been treating gold as a fringe investment or a relic, you may need to recalibrate your thinking. So where is gold going from here, and what are the credible institutional forecasts? JPMorgan Global Research has projected prices pushing toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 per ounce possible in the longer term. Goldman Sachs has raised its gold price target to approximately $5,400 per ounce by end of 2026. A Reuters poll of 30 analysts and traders put the median gold price forecast for 2026 at $4,746.50 per ounce. State Street Global Advisors, which manages the world's largest gold ETF, has projected a consolidation range of $4,000 to $4,500 for much of the year before a potential move higher. The World Gold Council anticipates central bank purchases will remain elevated at approximately 850 tons in 2026, down slightly from 863 tons in 2025, but still historically high. It is important to state clearly, these are institutional forecasts, not certainties. Markets can and do behave in ways that defy consensus expectations. Gold is a volatile asset. It experienced a 45% drawdown from its 2011 peak to its 2015 lows. Anyone entering a gold position today needs to understand that short-term corrections of 10 to 20% are entirely possible and historically normal, even within long-term bull markets. The question is not whether gold will go up in a straight line. It will not. The question is whether the structural forces driving gold's appreciation remain intact over a multi-year horizon. Based on the available data on fiscal trajectories, de-dollarization trends, central bank behavior, and monetary policy direction, most credible analysts believe they do. Now let's talk about how to actually invest in gold, because not all gold investments are created equal, and the differences matter both financially and from a tax and legal perspective. There are 5 primary ways a retail investor can gain exposure to gold: physical gold, gold ETFs, gold mining stocks, gold futures, and gold IRAs. Each has distinct characteristics, and the right choice depends on your investment horizon, risk tolerance, tax situation, and where in the world you are based. Physical gold, in the form of coins and bars, is the oldest and most direct form of gold ownership. In the United States and most of Europe, purchasing physical gold is entirely legal and does not require reporting to tax authorities at the point of purchase. However, when you sell physical gold, the IRS in the United States classifies it as a collectible, meaning long-term capital gains are taxed at a maximum rate of 28%, higher than the standard 15 to 20% long-term capital gains rate that applies to stocks. In the UK, physical gold coins that qualify as legal tender, such as the Britannia or the Sovereign, are generally exempt from capital gains tax. In most European Union countries, gold bars and coins that meet the investment grade standard, meaning at least 995 parts per thousand purity, are exempt from VAT under EU directives on investment gold. In Russia, investment gold has been exempt from VAT since 2022, following legislative changes designed to encourage domestic gold holding as a savings vehicle. In Canada, gold bullion is also exempt from the goods and services tax when it qualifies as investment-grade metal. Storage and insurance are legitimate costs of holding physical gold. Professional vault storage typically runs between 0.1 and 0.5% of the asset's value annually. These costs are real and should be factored into your expected return. A useful strategy for managing physical gold acquisition is dollar cost averaging. Rather than buying a large lump sum at once, you invest a fixed amount at regular intervals regardless of price. This approach removes the psychological pressure of trying to time the market and smooths out your average cost per ounce over time. Gold ETFs offer a more accessible and liquid alternative. The largest and most established is the SPDR Gold Shares ETF, ticker GLD, which holds physical gold in vaults and has assets under management exceeding $100 billion. The iShares Gold Trust, ticker IAU, offers similar exposure at a slightly lower expense ratio. JPMorgan forecasts around 250 tons of inflows into gold ETFs in 2026 alone, reflecting growing institutional and retail demand. However, the tax treatment of physically backed gold ETFs in the United States is critical to understand. Many of these funds are structured as grantor trusts, which means the IRS treats them as direct ownership of gold, and therefore subjects gains to the same 28% collectibles rate as physical gold, not the standard capital gains rate that applies to equity ETFs. This surprises many investors. By contrast, gold mining company stocks and ETFs focused on mining companies are taxed like regular equities at the standard capital gains rate, which can be a meaningful difference for high earners. Gold mining stocks represent a leveraged form of exposure to gold prices. When gold rises, mining companies' profit margins typically expand faster than the gold price itself, because a significant portion of their costs are relatively fixed. This leverage can amplify returns significantly in a bull market. Conversely, in a falling gold environment, mining stocks can decline faster than gold itself. Key names that institutional investors monitor include Newmont Corporation, Barrick Gold, Agnico Eagle Mines, and Franco-Nevada, which operates as a streaming and royalty company rather than a direct producer, offering a different risk profile. For those who want diversified mining exposure without picking individual stocks, the VanEck Gold Miners ETF, ticker GDX, provides access to a basket of senior gold miners. One important consideration for European and UK investors: cross-border withholding taxes on dividends from Canadian or US mining companies can reduce net yield, so understanding the tax treaties applicable to your country of residence is important before investing. Gold IRAs are a U.S.-specific vehicle that allows Americans to hold IRS-approved physical gold and other precious metals within a tax-advantaged retirement account. The IRS requires that physical gold held in an IRA meet a minimum purity standard of 995 thousandths fine, and it must be stored in an IRS-approved depository. You cannot take personal possession of the metal. Traditional gold IRAs allow pre-tax contributions with tax-deferred growth, while Roth Gold IRAs use post-tax contributions but allow tax-free growth and withdrawals in retirement. The setup and annual custodian fees for gold IRAs are higher than standard IRAs, often ranging from $150 to $300 annually plus storage fees, so this vehicle makes most sense for investors with larger balances and a genuine long-term horizon. When it comes to portfolio allocation, the academic and institutional consensus is that gold should represent somewhere between 5 and 15% of a diversified investment portfolio for most investors. Investors with strong convictions about monetary instability, persistent inflation, or geopolitical risk, might extend that to 20% or beyond. The key principle is that gold functions primarily as portfolio insurance. It tends to preserve purchasing power and reduce portfolio volatility during financial crises, currency crises, and periods of elevated inflation, even when its performance is modest in stable, high-growth environments. A realistic return framework is essential here. Gold has delivered approximately 8.2% compound annual growth over the past 25 years. That is a meaningful real return, but it is not the 60% of 2025 every year. Investors who allocate to gold expecting guaranteed double-digit annual returns will be disappointed in some years. The most disciplined approach is to treat gold as a long-term strategic holding within a diversified portfolio. Not a trading instrument, not a get-rich-quick vehicle, and not a replacement for income-generating assets. Rebalancing is important. If gold surges and your allocation grows from 10% to 18% of your portfolio, trimming back to your target allocation and reallocating to underweighted assets is sound financial practice. Risk management around a gold position requires thinking about several potential scenarios that could pressure prices. If the U.S. economy enters a period of unexpected strength with rising real interest rates, that is, rates rising faster than inflation, gold could face meaningful headwinds. If the Federal Reserve reverses its easing cycle due to a resurgence in inflation and hikes rates aggressively, that would typically create a more challenging environment for gold. A significant strengthening of the U.S. dollar, possibly driven by safe haven demand during a global risk-off event, could temporarily suppress gold even while broader concerns about fiscal sustainability persist. None of these scenarios would necessarily invalidate the long-term structural bull case for gold, but they could create short-term drawdowns of 10 to 25% that require investors to have the conviction and financial stability to hold through volatility without panic selling. There is also the geopolitical dimension, which in 2026 remains highly elevated. Gold has a long documented history as a safe haven asset during geopolitical stress, a pattern visible during every major conflict, financial crisis, and political shock of the modern era. The ongoing tensions in Eastern Europe, instability across the Middle East, escalating U.S.-China economic competition, and growing fragmentation of global trade under tariff regimes have collectively created a geopolitical risk premium embedded in gold's current price. For investors in Europe, Canada, the United Kingdom, and Russia, understanding the dual nature of gold, both as a financial instrument and as a genuine safe haven outside the banking system, is especially relevant given regional proximity to these ongoing stresses. For Russian investors specifically, the domestic gold market has become particularly significant since 2022. Russia is the world's second largest gold producer, and domestic gold buying has been actively encouraged through regulatory changes. The Moscow Exchange offers gold trading instruments, and major Russian banks, including Sberbank, offer various gold savings and investment products. The exemption of physical gold from VAT since March 2022 was a deliberate policy signal, and data shows Russian household gold purchases surged significantly in the 2 years that followed. Tax treatment on gold gains in Russia follows standard personal income tax rules at a 13% rate for residents, rising to 15% on income above 5 million rubles annually, which is substantially lower than the U.S. collectibles tax rate. For investors in Canada and the U.K., gold investments through registered savings vehicles offer additional tax efficiency. In Canada, physical gold that qualifies as a Canadian capital property can be held within a tax-free savings account or a registered retirement savings plan through eligible gold ETFs. The iShares Gold Bullion ETF and Sprott Physical Gold Trust are both available on the Toronto Stock Exchange and can be held within registered accounts, allowing Canadians to benefit from gold's appreciation completely tax-free within their TFSA contribution limits. In the UK, gold is excluded from the individual savings account framework for physical bullion, but gold ETFs can be held within a stocks and shares ISA, allowing UK investors to shelter gold exposure from capital gains tax entirely, a significant advantage given the UK's general CGT allowances have been substantially reduced in recent years. Looking at the broader macro picture as we progress through 2026, several converging forces are creating an unusual environment. The US dollar's structural position as the world's reserve currency is not disappearing, but it is being incrementally diversified away from. The $38 trillion national debt is not a crisis today, but represents a long-term constraint on fiscal flexibility and monetary credibility. The Federal Reserve's pivot toward lower rates has reduced the opportunity cost of holding non-yielding assets like gold. Central banks across the emerging world, particularly in China, the Gulf states, and Eastern Europe, are systematically reducing Treasury holdings and building gold reserves. And global investors, burned by bond market volatility, sovereign debt concerns in multiple economies, and currency crises from Argentina to Turkey to earlier experiences in Europe, are treating gold allocation not as speculation, but as fundamental portfolio risk management. The Morningstar analysts who recently published a research note describing gold's potential for what they called a $10,000 supercycle deserve a careful reading. Their argument is not that gold will inevitably reach that level, but rather that the confluence of persistent fiscal deficits across major economies, declining confidence in fiat currency systems, central bank accumulation, and generational shifts in how young investors think about money and value storage all point toward a long secular bid for gold. Whether the price reaches $5,000, $6,000, or more over the next several years will depend heavily on how U.S. fiscal policy evolves, how the Federal Reserve manages the tension between inflation and growth, and how aggressively other currencies and reserve assets emerge as alternatives to the dollar system. What does all of this mean practically for you, sitting wherever you are watching this right now? It means that doing nothing, keeping all of your savings in cash or domestic bonds with no real asset exposure, carries its own significant risk. The purchasing power of the US dollar has declined by more than 97% since 1913. Since 1971 alone, when the gold standard was officially abandoned, the dollar has lost roughly 85% of its purchasing power. Gold, by contrast, has maintained and expanded its real purchasing power across the same period. This is not speculation. It is the documented historical record. The most actionable path forward is one built on discipline, not emotion. Start by calculating what percentage of your investable assets you currently have exposed to real assets: commodities, precious metals, real estate, inflation-linked bonds. If the answer is very little, consider gradually building a 5 to 10% gold allocation over the next 6 to 12 months using a dollar-cost averaging approach. Choose the vehicle that aligns with your tax situation, time horizon, and preference for liquidity versus physical ownership. If you are in the United States, understand the tax implications of your chosen vehicle before you invest. The difference between collectibles tax rates and standard capital gains rates is meaningful and should inform your structure. If you are in Canada or the UK, explore the registered account opportunities that could allow you to compound gold's appreciation completely tax-free. Wherever you are, avoid the temptation to overallocate in a moment of enthusiasm and then panic sell during the inevitable corrections that will come. The gold versus dollar dynamic is not a binary zero-sum outcome. The dollar is not about to collapse. Gold is not going to replace fiat currency in your daily life. What is happening is more nuanced and more important. A slow but measurable repricing of confidence between a paper monetary system increasingly strained by debt and a physical asset that has functioned as money for 6,000 years. The institutions that manage the world's largest pools of capital have already made their read on this situation. Central banks globally now hold more gold than U.S. Treasuries for the first time in modern history. They are not doing this because they expect gold to make them rich quickly. They are doing it because they understand that wealth preservation across decades and generations requires anchoring your portfolio to something that cannot be conjured out of thin air by a committee decision. The great financial educator Warren Buffett has famously been skeptical of gold as an investment. His argument that gold does not produce earnings, pay dividends, or build anything has merit when evaluating it as a growth asset. But even Buffett's own Berkshire Hathaway briefly held a large stake in Barrick Gold in 2020, signaling that even the most equity-focused investor in history recognized the moment when gold's role in a balanced portfolio made sense. The role of gold is not to make you wealthy in the way a great business compounds over time. Its role is to protect the wealth you've already built against the erosion of monetary debasement and systemic financial stress. In an era where the national debt is $38 trillion and rising, where deficits are running near 8% of GDP, where the dollar has already fallen to 4-year lows, and where central banks have collectively decided that gold is now their single largest reserve asset, that role has never been more relevant. You now have the data. You have the historical context from 1971 to today. You have the institutional forecast from JPMorgan, Goldman Sachs, the World Gold Council, and State Street. You have the legal and tax framework for the United States, Canada, the United Kingdom, Europe, and Russia. You have the risk management principles, the realistic return expectations, and the step-by-step allocation strategy. The question that remains is the one that always remains in finance. What will you actually do with this information? The wealth you protect or grow over the next decade will be determined not by what you knew, but by the disciplined decisions you made based on that knowledge. The 2026 showdown between gold and the dollar is not just a market event to observe. It is a financial moment you can actively navigate with clarity, preparation, and purpose.